Well, I'll tell you what you do. You check in with some people who do this stuff for a living, like David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital. David, after those 2 really strong years for equity investors in the stock market, after arguably a very rough 2022, how do you kind of position the opportunities in the markets for 2025?
Good morning, Paul. Yeah, it is getting more precarious, or at this time, we're looking at markets more cautiously. We have the S&P 500 PE extended up a little over 22. The PE ratio up a little bit over 22. The market is really priced for perfection right now. And so everything really has to go right for the rally to continue. There are a lot of catalysts in that regard that look favorable for the markets going forward. But it makes sense to, as we've already talked about on the show, broadening beyond the Magnificent Seven. We talked about the Magnificent Seven a lot in 23 and 24. But to broaden beyond those, to look at mid caps, to look at some foreign markets that are actually becoming attractive in 2025, and so that investors have a portfolio that's diversified in a way that it is acceptable for the volatility they might see as we progress through 2025 here.
How are investors reacting when you tell them that it's time to get into international? Because I feel like that has been a theme that people have been testing the waters on for a couple years. And actually now, at least year to date, it has worked. Europe is outperforming the US year to date. Yeah. But I'm wondering if there's any hesitancy from investors to try and get in on that trade that hasn't really worked long term.
Right, Emily, that's a good point. And it really hasn't worked well for a couple of decades. It's really not, if we look at the performance of international markets compared to the U.S., it's really been the U.S. that's been the outperformer to the extent that when we look abroad, China has been uninvestable for a lot of reasons. It showed a little resurgence lately, but we're looking more at Europe for potential. They haven't been impacted by the tariffs yet, maybe won't be impacted. In fact, the tariff policy, Trump's tariff policy is more about foreign policy and gaining leverage than implementing tariffs. All we have right now is a 10% tariff on China, and he's talking about a potential trade deal with President Xi. So the fundamentals for Europe and for most foreign markets really aren't as strong as the U.S., but here in the near term, we think there's opportunity because of being so undervalued, a PE down around 14 for Europe. It looks like the recession may not be as deep, or their contraction as deep as thought. And so, there's some opportunity to opportunistically diversify abroad into Europe, we think, and, give us a chance to move, try to diversify away from a U.S. market that we think can still do well this year. But, there are a lot of risks on the horizon, and we're just at, we're at very high levels after the past couple of years, up 60% since October of 22.
Yep. How about just in terms of market cap, David, small cap versus mid cap? And we know the big cap stocks have been kind of the place a lot of investors have been piling into over the last several years. It's where a lot of international investors have come into. How about small and mid cap stocks?
Yeah, we prefer mid caps over small caps right now. And the reason for that is there's the refinance risk for small companies. We always say when we look at small companies or the Russell 2000 index, 42% of the companies in that index are not profitable. And what happens to small cap companies? If they do well, they grow into the mid cap range, into the mid cap index. If they also we have a lot of companies going private with so much M&A and PE money buying public companies, and you get left with a lot of small caps that don't look as opportunistic. Now, are there good small cap opportunities there? Yes, we think the risk is lower and the opportunity better in mid caps, and we still think you own large caps. We still think you own those large mega cap tech stocks that should be a long-term position in any portfolio because of their fortress balance sheet, their wide moats. The opportunity that they're going to be beneficiaries of the booming industry of AI.
I recently wrote a piece about Bitcoin's correlation with U.S. stocks and gold. And it's pretty low. It's pretty close to zero, which would mean not as much of a correlation and perhaps a case that it could be a diversification tool. And I'm wondering what you think of that, David. Do you see Bitcoin in 2025 becoming a tool in the asset allocation toolbox where you can use it to diversify and hopefully see some meaningful returns?
Yeah, we have a total return portfolio that has a very, very small amount of crypto in it, specifically Bitcoin. And, our position on that is, Bitcoin is here to stay. It's become an asset class in and of itself. And, testament to that is there are now Bitcoin ETFs. So it's got institutional acceptance, and some of the fund companies or wirehouses that were naysayers just a few years ago are now promoting Bitcoin. They have ETFs that are priced based on Bitcoin. So, it should be if it is part of an investor's portfolio, a very, very small part because it is so volatile. Some have compared it to a even larger gain factor on the volatility of a NASDAQ 100 of the NASDAQ 100 index. But it is an asset class in and of itself. It's here to stay, and the people that have been the naysayers that there's no, whatever it may be, they've been humbled because it's performed well since its inception with a lot of volatility. That's what investors just have to be prepared for if they're going to entertain Bitcoin or another crypto in their portfolio. And we recommend doing that through an ETF, certainly.
David, what are you telling your clients about fixed income these days? I mean, I can sit in a 2-year treasury and get 4.25% here. Do I do that? Or do I take some credit risk and look for some higher yields?
Yeah, we think that this has really been our strategy for a while. With the money market rates and just shortest end of the curve coming up so high, there are high yield bond funds and ETFs, bond portolios that we've gotten a yield of as much as 7 or 8%. So that results in a 7 or 8% return over a year. And we avoid the interest rate risk. The 10 years come down here recently, but over the past 4 years, what's been the path for intermediate term and longer term bonds? Rates have gone higher, prices have gone down. We've had a couple of negative years for the aggregate bond index. So we've chosen to stay on the shortest end of the curve and enjoy that high yield that we're getting with very low duration, so very low interest rate risk. Continues to work very well for us. I know there's talk about with reducing spending with what Doge has been doing, reducing government spending, trying to reduce the deficit. That may or may not happen, but what we see ahead is probably interest rates where they are here are a little bit higher and not as much help from the Fed as some might think we're going to get in 2025.
David, we only have about a minute left, but how worried were you about stagflation? Because I did see that word come up in the note that you sent over.
Yeah, we think that we're in an environment here where we need to think about the possibility of stagflation again. And the reason we say that is, rates are higher. We think that the risk really is to the upside versus lower rates ahead. So we have this higher rate environment, and the economy's been doing well, right? So for the growth component, we're at 2.8% GDP growth in 2024. But when we look at some of the anecdotal data out there with credit card delinquencies, personal debt, defaults on car loans, things that will cause some economic problems down the road, there's this real opportunity, or not an opportunity, this real threat that we could be entering or coming into a near stagflationary environment. And then that leads us certainly to look away from things like bonds and more to commodities for diversification like we did in 2022.
Hey, David, thanks again for joining us. Always appreciate getting a few minutes of your time. Very clear and concise outlook on these markets. David Kudla, he's the founder, chief executive officer, and chief investment strategist at Mainstay Capital Management, joining us from Troy, Michigan. Lovely Troy, a suburb of Detroit. He is also the founder and sponsor of Engage, the world's largest student stock pitch competition and conference hosted annually at the University of Michigan. I think that is very, very cool.